Morning, everyone. Welcome to NIESR's Spring Economic Forum. We'll just give people another couple of minutes to join, and then we'll get going. Okay, well, we we have plenty of participants now, so I'll kick us off. Welcome to NIESR's Spring Economic Forum. My name is Stephen Millard. I'm the Deputy Director for Macroeconomic Modelling and Forecasting here at NIESR. I'm joined by Dr. Kima White, who will be presenting the UK outlook, by Professor Arnab Bhattacharjee, who will be presenting the UK regional outlook, and by Barry Naisbitt, who will be presenting the global outlook. Just thought I'd say a few opening remarks ahead of the presentations. Obviously, the main event that has happened since our previous outlook has been the war in Ukraine. And as ever, I want to make it clear that we stand with everyone in Ukraine and all Ukrainians wherever they are. The war in Ukraine is the third of a set of large shocks that the UK economy has faced over the past few years. Brexit has been one, then of course we had COVID and the lockdowns, and now we have the war. And between the three shocks, the UK economy is gonna have problems this year. But not just the UK. The main message coming out of our global economic outlook is that global growth will disappoint as a result of the war. Within the UK, we're going to see higher inflation. We're going to see near zero growth for a while. This is what you'd expect for a supply shock that acts to push up on prices and push down on growth. More importantly, though, we're likely to see increasing inequality and a cost of living crisis that will hit particularly the poorest households in our society. And a message that we've been putting forward in NIESR for quite a long while now is that we're seeing the wrong mix between monetary and fiscal policy. Fiscal policy is tightening at a time when, as I said, the poorest households in society could really do with the support. And because fiscal policy is too tight, that makes the job of monetary policymakers in trying to bring inflation down that much harder. But that's enough for me, I think. I'm now going to hand over to Barry Naisbitt, who's going to talk us through the global economic outlook. Barry, over to you.
Thanks very much, Stephen, and good morning and welcome to everyone on the webinar today. I just want to talk you through the main themes of our global economic outlook, and in particular talk about how it's changed since I last did this talk 3 months ago. As those who've been to these talks before will know, our global economic outlook is very much a team effort. At the moment, I'm just sort of going through it for you, but the other members of the team whose work's very important to the production of the forecast on names on the slide there for you. We use our own global macroeconometric model NIGEN to run the forecast, And clearly, if you're thinking of subscribing to our global econometric model, you'd be very welcome. So let me just start now with looking at the main sort of highlights, which I entitled the economic shock of war. I mean, the key point is that at a time when the economy, the global economy, was still recovering the pandemic shock, not all countries had yet recovered back to their pre-pandemic GDP levels. The shock from the Russian war in Ukraine has hit the global economy. And our headline is that as a result of that shock, we've revised down our forecast for global GDP growth this year and next. We've revised down by 0.9 percentage points to 3.3% this year, and by about 0.2, not by 0.3 percentage points next year to 3.2%. This is largely a result of the war in Ukraine, but also due to this ongoing and scarring effects of COVID-19, and also the fact that we're actually seeing still supply chain disruptions continuing. And in particular, we've seen inflation be higher at the start of this year than we were predicting 3 months ago. And we just had another inflationary shock added on to that. And so for the OECD, we're now projecting inflation at 8.2% this year, up from our previous forecast of 5.2%, before we expect inflation to fall back next year to 4.4% and then moderate further to around 3% in the medium term. If I look at some of the other changes that have happened, clearly the higher than anticipated inflation has led to substantial monetary policy tightening. Largely it's happened in the month of May, but also in terms of our forecast, because of the expected higher tightening, we've got higher profiles of interest rates, policy interest rates, particularly for the US, but also for the Euro area and the UK. The higher inflation and the slower GDP growth expected means that central banks are going to have to, what we use the phrase, walk the line between tightening policy to restrain inflation and restrain inflationary expectations, but also creating the risk of contributing to a marked slowdown in global economic growth. A further escalation of international tensions, or the possibility of the effect of the observed higher levels of food and prices generally might have a larger effect on emerging market economies, and that's amongst the key downside risks to our forecast. It's just quite important to look at just briefly some of the effects of inflation that we're seeing. We're seeing obviously substantial rates, multi-decade high rates of inflation in the US and the Euro area, but the profile of those inflation rates is slightly different. So the Euro area more exposed to the increases in oil and in particular gas prices. I'll come on to that later, from the effects of the war in Ukraine. You can see that the Euro area has seen a larger contribution to its inflation coming from those energy price rises than the US has, where the US profile inflation is more evenly spread across the categories of food, energy, goods and services. Obviously, a key determinant of what will happen further to inflation will be what happens in labour markets and also what happens to inflation expectations. So what are central banks doing and what are we assuming they're doing? Well, the chart on the left shows you the very stark difference in the reaction of oil and gas prices to the crisis. And those economies that are most exposed to imported gas, and particularly the European economies, in particular Germany, Italy, and Netherlands, are seeing a more substantial effect on their economies. Oil prices have risen substantially, but are actually still not at all-time highs, and certainly not at all-time highs in real terms. In terms of interest rate profiles, we've already seen now, since the production of our forecast, further increases in bank rates. And the chart on the right-hand side shows the change in assumptions that we have made. We'd largely follow market information, and we follow the FOMC's dot plot chart as part of that. And you can see there that the rates are increasing faster and further and staying higher longer, if you like, into 2024 than we had in our previous forecast. Our global economic outlook itself, the text of it, for those who are subscribers, contains really 3 extra bits. The first bit is our usual NIGEM topical feature, where we use our model NIGEM to investigate a key issue of interest. And this time we're looking at the economic costs of the Russia-Ukraine war. We have 2 other boxes. The first box by Saul Eslake of Corinna Economic Advisory looks at the medium-term prospect for a slowdown in China's rate of economic growth. China's been powering ahead over the years, and we're now expecting that growth rate to slow over time. The second boxes are just short articles in effect. The second box concerns the war in Ukraine and the options for Europe's energy supply, and that's by Christopher Aitken and Erkel Ersoy of Heriot-Watt University. And both those add to our view overall, but in fact, the main driving feature of the change in our view is really to do with the war in Ukraine. What does our simulation using our NIGEM model show? And these are simulations relative to our pre-war baseline. We see a reduction in global GDP of about 1% this year and slightly less next year. The big effect is on Russia, and by assumption on Ukraine. We see Russian GDP about 10% lower than our baseline forecast would have been. Bigger effects in the euro area because of the energy dependence relative to the US and China. And the right-hand side chart shows that the bigger effects is in Germany rather than Spain, for example, Germany being more exposed to the higher energy imports. Lost 1.1% of GDP is about $1.5 trillion in PPP terms. We expect the war also to raise global inflation by about 2% this year and 1% next year compared to our pre-war forecast. And in particular, we're expecting a huge spike in Russian inflation in Q2 and certainly into Q3 this year. The effects are largely spread across countries, and within Europe, you can see that the larger increases tend to be in spread again widely across countries with much lower increases next year. Aside from the effects of the war, in the global outlook, we're still seeing divergence in growth experience across countries, a particular divergence between major advanced countries and the BRIC countries. We can see here that we see the slowdown continuing into 2023 with the sharp slowdown this year in advanced economies, but also we see in particular for BRIC countries very slow growth in Brazil, only just positive this year, but a huge fall in GDP in Russia this year. And we expect China to see growth just below 5% this year. Of course, in the background to all of this is the scarring effect of COVID on the global economy. We reckon a GDP at the moment globally is about 2% lower than we would have expected before the pandemic hit. The cumulative loss is around $25 trillion. And it's worth saying because I think it's worth saying because there's a lot of focus at the moment on the war in Ukraine, but COVID has not gone away. And in particular, one only has to look at the news of China to see that COVID is still having very destructive effects on that economy and by association on other economies through the slowing of trade in particular and of global supply chains. Of course, our forecast is almost more than usually subject to risks. If inflation sticks at higher rates, then fighting inflation might well have to come at the expense of hurting the growth of the global economy and the labour market. This is the issue about walking the line. Emerging economies face considerable challenges from central bank interest rate tightening, particularly in the US, and for currency depreciation as a result of that. And also over the period of the COVID, government debt has increased substantially. And so with it rising interest rates, there are increased challenges to government finances in the medium term. Let me just leave you with a quick summary of our headlines of our GDP and inflation and trade forecasts. And like you to just to say thank you for listening and let me hand over to my colleague Kamar, who will talk about the UK economic outlook.
Just to say before we go to Kamar that if you have questions on any of what's being presented, if you could put them into the chat box, and if you can make sure you write your name and affiliation as well when you write your question into the chat box. We should have about 20 to 25 minutes at the end to try and answer questions. But if you put them in the chat box, then that will speed things up on that one. Sorry to intervene there. I'll hand back to Kamar.
Thank you, Stephen, and thank you, Barry. So I'll just talk you through the outlook for the UK economy. And much like the global outlook, the UK outlook is very much a team effort. And this is work that has been jointly done with Rory McQueen, our Deputy Director Stephen Millard, and Irvish Patel. So just as a sort of roadmap to what I'll speak about in this presentation, we'll of course start with what's going on in Ukraine. I'll speak a little bit about what we foresee in the back end of this year, which is a technical recession. We'll talk a bit about inflation, which we forecast to be up and above 8%. And of course, the squeeze on real incomes that we've been seeing, not only this year, but also from last year. We'll speak a bit about also what we think is wrong with policy and what policy should be doing. And then finally, I'll leave you with what is a thought, which just came out of one of the analytical pieces in our UK economic outlook, which is on reindustrialization. So just to echo and re-emphasize the words of Stephen at the start, what is happening in Ukraine is of course a humanitarian crisis, and just like to re-emphasize the support both from myself and my colleagues at NIESR for our friends and colleagues in the Ukraine. But of course, there are economic consequences to what is happening in Ukraine. In terms of the economic impact, the war has led to further rises in oil and gas prices and inflation more generally. We have seen supply problems, specifically for the UK. This has sort of acted as a terms of trade shock, and as such would be expected to lead to a rise in inflation and a fall in output, and also a fall in real income. And this, of course, is reflected in our forecast for GDP, for inflation, for real incomes, and consumption over the medium term. So we do indeed have lower output. So we forecast GDP this year to be to grow by 3.5%. And this is some 1.3 percentage point lower than we expected just 3 months ago in our February outlook. We now expect output to actually fall, as I was mentioning earlier, in the third and fourth quarter of this year, though not by much. I must caveat this with, and this, of course, is what many of us will term a technical recession. And I just want to stress the point that we don't foresee a deep recession in the back end of this year, but a recession nonetheless. And indeed, in one of our boxes in the review, Peter Dixon, done by Peter Dixon, where he sort of examined the probability of a year-on-year fall in GDP. But what he finds is that the probability of this happening is actually rather quite low. So not a deep recession, but a technical one. And if you look at the chart, you'll also see that GDP growth is quite low for the rest of the forecast horizon. Of course, we can't forget about COVID and its impact on not only the global but also the UK economy. And COVID has led to a large drop in GDP in 2020. And we saw some of this come back, but it didn't come back all the way. So there is some permanent scarring. So our forecast is now about 5% lower than we were pre-COVID. But of course, some of this is also due to the war in Ukraine. The main idea here is that we sort of expect GDP to be permanently lower than where we were pre-COVID. Inflation. So of course, inflation keeps rising. And the chart here that you see, if you look at the chart, the green line here is where our forecast was in February. The blue line is the Bank of England's forecast. And the middle line is where our forecast is now. And together with the uncertainty that we think is around this, depicted by the shades of red. So you'll notice that we have a big jump in our forecast relative to where we were in February. We're now expecting a peak of 8.3%, whereas back in February, it was closer to 6%. The bank is expecting a peak of around 10%. Now we're sort of trying to think and understand what sort of accounts for the difference in where the bank sees its peak and ours. And essentially, we have put this down to how much we see, how much of the pass through from the energy price cap, both in April and October. And clearly, the bank expects a bigger pass through there. We expect inflation. Sorry if we just go back a bit to the So we expect inflation to come down fairly quickly. And this is on the back of higher interest rates than what are in the bank's forecast. We expect RPI inflation to peak at 14.4% this year. Now, of course, with this with surging inflation, there is a squeeze on real income. Excuse me. So what we've seen last year, actually in the final 3 quarters, in the last 3 quarters of 2021, we had real disposable income falling. And in the first quarter of this year, we also saw real disposable income falling. And we expect to see that carry through for the remainder of this year. Indeed, we see real disposable income falling by about just under 2.5% in 2022. And this is as a result, of course, of higher taxes and inflation. Back in February, we had a forecast of 1.1% increase. So this is a dramatic change in the forecast that we've seen for real disposable income for this year. Now, consumption we expect consumption to continue to grow above real disposable income. And this is largely because If you look at the red line, the little red triangles, this is where we have consumption. If you look back at 2020, you can see consumption fell dramatically, but income did not. So there's quite a lot of aggregate savings going on there. So I think we did some analysis, and I think this is something to the tune of about 200 billion in household savings. And this is what is allowing for consumption to run above income in 2021 and 2022. Now, this is a sort of the aggregate picture, right? And this sort of masks what is happening at the more disaggregated level. But my colleague Arnab will come on to that and give you a more in-depth analysis of what's happening at a more disaggregated level with the squeeze on real income. But I have to speak a bit about what the Chancellor could have done, we think, in our opinion, in his spring statement. So the Chancellor had the opportunity to do, we think, a bit more to help households in his spring statement. But we figure he chose not to. Instead, he chose to pay off, COVID assistance and for, added fiscal support by running down the deficit. So if you, from the chart, you can see we now expect the deficit to fall from 5.8% of GDP in fiscal year 21-22 to roughly 1% of GDP in 24-25. And notice that this is now lower than the deficit we were expecting pre-COVID, and that's represented by the red bars there. So there has been quite some tightening. But we think that this didn't have to be the case, because at the time of the spring statement, the Chancellor had about 20 billion of available money to spend, and that would still enable him to sort of remain within his fiscal rules. And of that 20 billion, he spent 10 billion, which means by my simple math, there's still another 10 billion that he could have spent helping households facing a real income squeeze this year. And as you can see from the chart, since the March 2020 budget, the government is now planning for the fiscal loosening to be followed by tighter discretionary fiscal policy in the coming years that had been planned before the pandemic. And the other thing to note is that the rules themselves have led to sort of a marked discretionary tightening, if you like. If you have a particular deficit at a particular time, and the economy is not in a good shape, then you have to sort of adjust policy and sort of loosen instead of continue to tighten, in our view. And we think that the failure of fiscal policy to support the right social outcome highlights the need for a rethink of the fiscal framework. Now, what about monetary policy? Well, the fact that fiscal policy has been too tight actually means that the MPC's job has become more difficult. So we do expect them to carry on tightening. We do expect the bank to carry on tightening this year, but not by much. Because of course, if they tighten too much, then they run the risk of plunging the economy into a recession. But we have to ask ourselves, should they have tightened sooner? Well, from the chart that we have here on the right, what we have here is the alternative paths for the bank rate. And the gray line that you see here, so first of all, the red line represents our outlook from our current forecast, and the black line is from our winter outlook. But the gray line represents a killer rule in our NIESR model. And it suggests that MPC should have been tightening dramatically over the course of 2021, and when it actually wasn't. So, and while I won't necessarily put too much focus on the value, the actual value here of 14%, we do believe that the picture here is quite stark, and we do think that it does paint a picture of where we think policy rate should have been. And because they weren't, this has sort of helped to add to the inflation that we are now seeing. So we have called for the bank. We think the bank should have tightened sooner, but also should have communicated better their policies. And because of this, the monetary policy now has to navigate treacherous seas. And this is between a rock of high inflation and the hard place of a recession, unfortunately. Because if they tighten too much, then we risk going into a recession. If they don't tighten enough, then inflation expectations will certainly take off. And this isn't obviously where the bank would want to be in a time when they've just recently celebrated their 25th birthday. And I like to, as I had mentioned at the start, just to put an idea out there, and this is some work coming out of one of the analytical pieces in our outlook, which I do implore you to have a read of if you can. And this is about reindustrialization. So as I mentioned, there's a box in the review written by my colleagues Paul Mortimer-Lee and Zhu Mao. And what they talk about is how the UK is sort of deindustrialized and try to make a case for reindustrializing. And the case that they try to make is sort of threefold. And the first one is to do with the fact that the war provides an argument for reshoring. So it's in a sense being able to produce stuff for ourselves more in the UK. Also, the move towards net zero, of course, requires new technology. So there's an opportunity there for us to be at the forefront of doing so. But of course, if we're going to do that, we would have to increase investment and, of course, lower, and this will obviously require quite a lot of savings and increasing investment and lowering the exchange rate. But as I mentioned, this is an idea put forward. It's obviously not a short-run solution. This is something that requires lots of thinking, and it's something more for the long term. So just to summarize what I've been through. So of course, the war in Ukraine has meant that we have seen higher inflation and slower growth. And with this comes a squeeze on real household income, especially for the hardest hit household. And I'm sort of preempting what my colleague Arnab will speak to in a bit. We think that policy action, particularly fiscal policy action, has been insufficient, and this has made the job of a monetary policy even more difficult. The risks in our forecast are particularly skewed towards the downside, and they are skewed to lower growth and higher inflation. And I'll just leave you with a summary of our forecast, and then I'll hand over to my colleague Arnab, who will speak on the regional economic outlook. Thank you.
Thank you, Kamar, and of course, Stephen and Barry before that. And good morning, everyone. Thank you all for joining us today for the NIESR Spring Economic Forum. Our team here brings to you the spring outlook for the developed nations, English regions, and households. Understandably, and as already preceded by the comments from Kamar and Barry, it makes grim reading. However, I think it is cause for not so much quiet contemplation, but insights for urgent action. The undeniable fact that many households are facing a stark choice between eating and heating is really a perverse reality for a high-income society and economy, and that is a serious cause for concern. Of course, as highlighted by Barry and also by Kimar, we are emerging from the shadows of COVID, but with severe scarring effects and stuttering recovery, which has then been compounded by supply chain issues, partly as a result of Brexit. Now, following on from that, there has been a war in Ukraine and rates of inflation not seen or anticipated in many, many decades. One of the severe implications of this is inflation hitting high-income households the hardest. Not surprisingly, demand is down and inequalities are up, both regional and income inequalities. But as highlighted by Kemar again, there is substantial fiscal space to help the poorest and the destitute, and indeed large segments of society that are struggling with the huge rises in cost of living. And therefore, the central message that we want to put forward is that the government needs to act and act fast. As you can see from the graphic here, the impacts of inflation, particularly in energy and food, but also transport, are hugely regressive, hitting the poorest households the hardest. What we plot here is across the income deciles, how much of disposable income is taken up by necessities, food bills in maroon, pink energy bills, other necessities in black, and then non-essentials in gray. Now, what we can see is, of course, this is regressive, but most importantly, on the extreme left, we see the hardest hit households, by which we mean households for whom food and energy bills together exceed their disposable income. And this is devastating. How many of such households are we talking about? Where we are talking about 5%. Many of them are in the bottom decile, but not all. There's also the second decile and a few in the third decile. Now, given the fact that many households are having to choose then between eating and heating, means that we can no longer assume fixed consumption shares. And therefore, measurement of poverty itself becomes a critical issue. And we place some emphasis on this in a box in the Outlook box D on measurement of extreme poverty, which has been authored by Max Mosley and Tibor Zandrai. So counting the cost of living, so that is what we're talking about here. So rising prices, higher taxes, they're squeezing the household budgets in 22-23. Of course, in the middle of the distribution, there are some households who would have accumulated, as already said by Kemar, some COVID savings, and they can drop on those savings. But still, it leaves 1.5 million households that face food and energy bills greater than their disposable income. This effect does not fall evenly across the regions of the United Kingdom, as expected. And the highest incidence we find is in London, Scotland, and Northern Ireland, but also part of the north of England and parts of the south, which are affected by this. So looking at the household budgets then, what kind of effect is there? And unfortunately, again, as highlighted, the Spring statement does not help things much. So first, there is the impact of benefits not rising with inflation, that is in black here, across the income deciles. Then there are the impacts also from the Spring budget on the national insurance threshold and the increase in national insurance contributions. Together, this effect is also substantial. But most importantly, there is the effect of rising inflation. And here, this excess inflation we calculate as above 5%, which is already accounting for a moderate increase in inflation. And this effect is devastating. It is very high for all households across the entire distribution, but at the extreme tail of the distribution, left tail of the distribution, it is absolutely devastating. So how much of an effect is it? We estimate that this effect going up to the median household would be about 4.2 billion. So in other words, the cost to the exchequer of bringing people in the lower end of the income distribution in line with at least the median would be a maximum of 4.2 billion, which is substantially lower than the fiscal space that the chancellor has to play with. This then implies that policy as such is not helping. The combined effect of inflation and the measures in the spring statement will hit the poorest households hardest. In 2023, the 11.3 million households in the bottom end of the distribution, so the bottom half of the distribution, would lose about 4.2 billion, more than the median household. If we had more targeted intervention, without more targeted intervention, more than 1 million households would be destitute, but the hardest hit households are still projected at 1.5 million. These are devastating numbers. As mentioned, the impact does not fall evenly upon space, and we can see here the largest impacts in London, Scotland, Northern Ireland, Yorks and the Humber, but then there are other regions of the United Kingdom as well, which are suffering as a result of this. So in terms of policy options, what we suggest is that the Chancellor should provide emergency support to cushion the 4.2 billion shortfall by doing two things. One is targeted most at the extreme lower end, and that is an uplift of 25 pounds per week between May and October of this year, which would cost about 1.35 billion. This is for the destitute households at the bottom end of the distribution. Together with that, and because the costs of inflation are borne by a much larger segment of society and the economy, an additional 2.85 billion as a one-off cash payment of about 250 pounds per household in the year for the bottom half of the distribution, that is about 11.3 million lower income households. Together, this comes to about 4.2 billion of targeted welfare. Where would this money come from? Well, we are arguing that this money is already there. According to the OBR, the government has a fiscal windfall about 20 billion. And as Kimar mentioned, if they have already spent around 10 billion, they still have 10 billion to play with. So these two measures, a temporary universal credit uplift of 25 pounds per week for 6 months, and a one-off cash payment to 11.3 million households of about 250 pounds would cost 4.2 billion in 2023. There is sufficient fiscal headroom to achieve this, and at the same time, help the hardest hit households in society. In effect, our proposals provide targeted help, efficient and effective, rather than spreading welfare around. And together, these two measures would cover only about 3.8% of the total welfare budget or the benefits budget. But on the positive side, the recipient households at the bottom end also have very high marginal propensity to consume, which would then boost the fiscal multiplier. So the net effect to the economy is positive. Without this targeted support, however, we project severe increases in extreme poverty. Around 250,000 more households will slide into destitution, taking the total number to about 1 million. and approximately around another 500,000 households will face the choices between eating and heating, which is perverse in our society. In conclusion, the consequences of the repeated shocks have brought about severe squeeze on household budgets. Regional regeneration is more urgent, yet less likely as a fallout of that, and partly a solution might be to reindustrialize. But beyond that, there is fiscal room for maneuver to help the hardest hit households in the short and medium term. Thank you.
Thank you, Arnab, and thank you also, Kimar and Barry. We have a little bit of time for questions, so keep putting your questions into the chat box or the Q&A. I'm going to read, well, the first one out. This is for Barry, and it comes from Bob Bradley, MD to MD. Barry, you mentioned global growth looking like 3.3% and showed a graph going back to 2021, but that was exceptional. So what was the rough norm prior to the pandemic? Is he right to think it's around 6%?
Sorry. So unfortunately, Bob, you're a bit too high. I took a chance to have a look at the figures while the call was going on. And between 2001 and 2008, so before the financial crisis, we're looking at global growth somewhere around 4.2% a year. And just for comparison, and because I mentioned the issue of China slowing down, over that period, China's 10.7% a year. So very rapid growth. In the last decade, so 2010 onwards up to the pandemic, we're looking at 3.7% a year globally, and China 7.7% a year. So the 3.3% is slow in two contexts. One, it's slower than where we have been, but it's also a continuation of a process of slowing down of global economic growth. But two, we have to remember that the global economy actually shrank in 2020. The global economy shrinking is an unusual occurrence, shrank by 3.1%. So we had rapid growth last year, 5.8, but globally that doesn't take us back to where we would have wanted to be. And that's the point about scarring. So we and others were expecting the growth this year to be slower than the 5.8 we got last year, but still above, if you like, sustainable trend, or what we think of as long-term trend. And what we're now expecting for us not to be in that position. And with the risks at the moment still, as I tried to say in the presentation, over this year and next, to the downside. I hope that helps answer it.
Thanks, Barry. I have a question from Jim Nugent, Allied Irish Banks, about the permanent scarring. So this was my fault in that I gave Kimar the chart and told him the wrong bullet point. But the 5% permanent scarring, that's the combination of what's happened with COVID and with Brexit, and to the extent that we have any from the war as well. So Jim's question is whether that's equivalent to our estimate of the long-term effects of Brexit. The long-term effects of Brexit is part of that. And another question has been asked about whether we can actually split those effects up into how much is COVID, how much is Brexit. And the answer is that's something that we plan to be doing over the next 3 to 6 months. So we'll have an answer next time around. Unfortunately, not this time.
Yeah, if I might just add to what Stephen has said. Yes, you're absolutely right. Like it's a bit difficult to disentangle, and as Stephen pointed out, that the 5% loss or the 5% scarring that we've mentioned is a combination of Brexit, COVID, and to an extent the war. But when in the past we've looked at Brexit, we've seen that this has predominantly affected the traded sector, whereas COVID has impacted the non-traded sector, particularly the services sector, which is of course quite important to the UK economy. And it's just a combination of these factors now, which has led to this 5% scarring that I mentioned earlier on GDP.
Thank you, Kemar. Peter Dixon followed up on that question by asking if we could disentangle the effects. He also asked, do we have a view on what the combined effect of these factors will be for UK potential growth? I mean, my view is that there'll be no effect on growth. The scarring is a permanent fall in the level. But while I'm responding to that, I'm kind of hoping that this is the same Peter Dixon who very, very kindly wrote a box for us in the UK Economic Outlook. It gives me a chance to thank him publicly for that, where he looked at what is the probability of a deep recession, a recession that actually would result in a year-on-year fall in GDP. And he found that probability, at least for this year, to be negligible. And I think that's worth saying. So we are forecasting a technical recession at the end of the year. We think output will drop in Q3 and it will fall again in Q4. But these falls are actually relatively quite small. And certainly if you take the year 2022 as a whole, we're still much higher than we were in 2021. So technical recession at the end of the year, and then GDP flatlining for a period of time after that. And again, many thanks to Peter for writing the box on that topic. Okay, I have another question for Kemar here from Alan B. To what degree will a fall in the savings ratio and credit behaviors help to mitigate the downside risk to domestic consumption?
Yeah, thanks for the question. And it's as I mentioned earlier, that it would go some way in sort of mitigating the downside risk to consumption. And if you recall, on the slide where I was showing what's happening to real personal disposable income, we also showed consumption running over the past 2 years above income, and that is largely as a result of the people drawing down on those savings that has been accumulated over the sort of forced lockdown period. So yes, I do think that the fall in the savings ratio will sort of facilitate consumption and obviously reduce the downside risk to consumption.
Okay, Kemar, following up on the theme of people who write boxes for us, we have a question from Paul Mortimer-Lee, who together with Zhujin Mao wrote the box on reindustrialization that Kemar referred to. The questions are not about reindustrialization, they're about inflation. So question 1 is, what do we have for wages? And are they responding fully to the increase in inflation? And the second question is the improvement in the fiscal deficit due to a relative price effect, i.e. that public sector prices and wages are increasing far slower than private sector prices and wages?
Thanks again for the question. I think we might have to put a ban on people who write boxes for us asking questions. But no, certainly not, Paul. Wages are not at the minute keeping up with inflation. I think for this year we have wages growing by I think 5.5%. So clearly nowhere near as much as inflation. And on the second part of your question, you're right in the sense that at the spring statement we saw where the government received a net sort of fiscal windfall, and this was largely as a result of faster rise in nominal earnings and prices in a context of sort of previously announced decision to freeze the income tax threshold from April, rather than rising them in line with inflation.
Thanks, Kima. We have a question now for Arnab. This is from Glenn Bramley. To Arnab, strongly support the general line of argument and need to focus additional support on lowest income group unable to afford essentials. You referred to destitution at various points, but I'm not clear what exactly your definition of this is and whether it's consistent with the Joseph Rowntree definition and the way this is implemented, both income and material essentials criteria, plus actively using crisis service, implying exhaustion of savings credit and informal support. So we are expecting the 4th destitution survey in autumn to show a marked increase on the 1 million households that were found in 2019. We should discuss this further. That's Glenn Bramley. So Arnab, the question in the middle of that is, are we defining destitution in the same way that is done by the Joseph Rowntree Foundation?
Thanks a lot, Glenn. And Glenn is one of the experts on destitution in the country, so it's a great pleasure to have him engaging with the questions. The answer is yes and no. So we are using the income component of the Joseph Rowntree Foundation destitution benchmark, together with a little bit of liquid wealth as well. So 5%, we are assuming that households can potentially liquidate 5% of their liquid wealth to support consumption if need be. So that is one thing. However, because that is based on a particular income measure for a week, this assumes fixed consumption shares, and it also assumes fairly stable prices. Under the context that we face now, where certain households, quite a lot of them, are actually facing a choice between eating and heating, and therefore this has implications for change in their consumption basket itself, or the consumption shares itself, we think, and also very rapidly rising prices, we do not think this is entirely adequate. We have a box in the outlook to explain our measure of hardest hit households, and that is essentially that disposable income that falls short of food and energy bills put together. And that is the measure that we are using to, in some ways, get at, the people who are facing the greatest hardship at this particular point in time. We are doing the destitution numbers as well, but in addition to this, we have this definition in the current outlook. Thanks.
Okay, next question for Kima again. So this is from an anonymous attendee. You mentioned increase of universal credit. Actually, Arnab mentioned the increase of universal credit by £25 and the one-off payment of £250. The question for Kima is, would this not further increase inflation and prolong the problems?
Sorry, this is a question for me and not Arnab.
Arnab, if you want to take it, you can take it either. I thought it was kind of an aggregate question, but I'm happy for either of you to answer.
Yes, sure. So in principle, that can be an effect in that direction. However, our calculations show that the larger effect is the opposite, and that goes through inequality. There is a strong link between inequality and inflation, and it potentially goes in the opposite direction. Besides that, there is also higher potential for higher consumption in the lowest end of the income distribution, which might counteract. However, all of this is at this stage preliminary, so we are going to go into more analysis of this in the future outlooks to bring this out in a better way. So, the tentative conclusion that we draw is that because of impacts on reducing inequality, targeted welfare, I mentioned very specifically, targeted welfare might, we think, have positive effects overall. Thank you.
Yeah, sorry, just to add, thanks, Arnab, just to add to what Arnab has said, because we sort of looked at this as well. So the sort of I think Arnab had mentioned in his presentation, the sort of 4.2 billion, which they will cost the government. We took a look at this using our our global econometric model NIGEM to see what the impact of this transfer would be on inflation. And what I can tell you is that the impact is sort of negligible. It's a very, very, very small, little to no impact on inflation. So our response is that no, there isn't a sort of worry of this transfer from the government having a sort of marked impact or marked or prolonged impact on inflation.
Thanks, thanks both. Jim Nugent had a follow-up question, which is, have we estimated the impact of the Northern Ireland Protocol on prices, costs facing households and businesses in Northern Ireland? I suspected this question would come up, given all the news at the moment about what's going on in Northern Ireland. Unfortunately, we didn't really look at the protocol for this particular outlook, but it is very, very much towards the top of the agenda for our forthcoming outlook. So with 3 months down the line, we will know the answer to that question. At least we hope so. It is now gone 12 o'clock, which is our scheduled finishing time. I'd like to thank again everybody who presented, Kemal White, Anna Bhattacharjee, and Barry Naisbitt. But more importantly, I'd like to thank all of you for participating, coming along to our webinar, asking the right questions, challenging questions. That's what sort of keeps us going and provides us with the ideas for the research that, as I say, will go into the forthcoming economic outlooks, which will come out right at the beginning of August. And yeah, until then, thanks everyone. Bye-bye.
Thank you.
Bye-bye.